Starting today, millions of families will be seeing something extra in their bank accounts. The IRS begins distributing monthly payments as part of the federal child tax credit. And joining us this morning is financial professional Brian Levy from BML Wealth Management. Brian, great to see you again.
Great to see you.
All right, so can you talk to us about moving forward here? What do families need to know about these monthly payments?
Yeah, so money's coming again. That's what everybody needs to know. I could definitely stand behind this one, Adrian, with someone with 3 children. I know how expensive it is, but this is all a part of the American Rescue Plan. So it's not new that we have the child tax credit. It's new that they're going to start distributing that and advancing it on a monthly basis. So kind of to break down what that looks like, if you have children under the age of 6, you can receive $300 a month. And if you have children between the ages of 6 to 17, you could receive $250 a month. And it's going to come out on the 15th of every month. But don't be so quick, because there is income limitations. There are phase outs. So if you make over $75,000 a year as a single individual or $150,000 as a married couple, you could potentially phase out and not actually qualify for these benefits. But everybody keep an eye out for their bank account today. If you fall under those guidelines, you should see deposits in your bank account. And the IRS has already sent out, I know, at least 1 letter, maybe 2, notifying if you are eligible to start receiving these payments. But the reality is, Adrian, it's really just an advancement of the tax credit you would receive at the end of the year.
So should some of the families opt out of the monthly payment?
There definitely are situations where you're going to want to opt out. One of the big ones is if you make over the limit. So in other words, if you make over the $75,000 threshold or the $150,000 threshold as a married couple, you could actually have to pay the money back. So it's not a free lunch. If you don't qualify, you need to go on. The IRS has a tool, and you have an ability to opt out. That's probably the biggest reason you're going to want to opt out, because if you made more money in 2020, no, maybe not because of the pandemic, but if you did, and you think you're going to make more money in 2021 than you did in 2020, that could be a reason why you want to opt out as well. You know, the other reason possibly is you like an end-of-year check, or you're one of those that really enjoys a lump sum refund. You may not want to get it in installments throughout the year.
Okay. And what are some of the smart ways that families can use this child tax credit? Because it's very tempting once you see that more money in your bank account to just go out and spend it right away.
Yeah, I mean, absolutely. Especially when it seems like free money. I think we have a tendency to, now we're stimulating the economy. Let's go to South Coast Plaza or, you know, one of the malls. But you're right, Adrian, there's a pecking order of how and really what you should be doing with this. Number one, obviously, if you need it and it's a necessity, and really use it for what it's for, which is to help your children, food, clothing. This is going to help a lot of people throughout the year. The other one is if you don't really need it for that, then I would look to save it, put it away, add to that 6 to 12 month emergency fund that everybody should have. And, you know, there's no time like the present in terms of saving. And then lastly, if you don't need to save, you already have your emergency fund set aside, go ahead and invest it. Go ahead and put it into an investment account or an IRA or a Roth IRA for future growth. So try and be smart with it. If you need it, use it. If not, make sure to put it away for a rainy day.
Well, thank you for the insight, Brian. Brian Levy from BML Wealth Management. Thank you for joining us. And somehow that money always ends up going back to the kids, right? Great to see you, Brian.
You too.
Thanks.